Today in studio, we have Peter Hodson, CEO of 5i Research, an independent research network. Peter, thank you for being in studio.
My pleasure.
So please give us some information on dividends. It was actually posted on your site this week.
Yeah, we wrote a blog talking about companies that have paid dividends for the past 10 years. And we really love dividends, of course, because they prevent investors from selling too early. We like growing dividends, and we really like first dividends. So when a company starts off their very first dividend, it's quite a significant statement where the company's saying, we have the cash flow, we have the earnings, and now it's time to reward our shareholders. So that's probably our single most best indicator of future growth for a company.
Great. And can you tell us about investor sentiments for the summer? What can you project despite the volatile market?
We'd really like to see a quiet summer. It's been about 10 years. Gold's going to be very interesting. We've had an 80% rally in the gold sector, and a lot of investors will have to decide whether they want to join that party or avoid it altogether and maybe wait for a rollover to see what happens with interest rates going forward. So I think that's going to be a theme, and I think M&A is going to be a big theme. Credit is still widely available. There's been a lot of takeovers so far, and companies are really waving the flag saying if we can't get a valuation in the market, let's sell our company. We can get an 80% premium, 70% premium, and I think it's going to be pretty active.
Right. Interesting that you mentioned gold. I was going to ask you, you were previously at Sprott, so has your sentiment on gold changed?
So gold's gone way up after 3 years of decline. Prior to that, we had 12 years of increases in the price of gold. But I think really what investors need to understand is gold is an asset category and nothing else. It's part of the sector, it's part of the TSX, and you cannot get focused on it. You don't want to be one of the conspiracy guys where you think the world's going to end and you want to bury gold and put it in your basement and just hide forever and wait for the world to collapse. That hasn't worked for 30 years, and if it didn't work in 2008, it's probably not going to work in 2016. It doesn't pay a lot of money in terms of income or dividends. Most of the companies have a lot of debt, and frankly, I would be a little cautious right now after the big rally we've had. When I was a fund manager, if I didn't own gold right now, I would be worried about my bonus, and I'd be like, okay, what do I do? The year is partially over and I don't own gold, everybody else owns gold, I'm falling behind the index, I'm falling behind my peer manager companies, I better own some gold. And when you think about it, that's not a fundamental reason to buy gold. That's some manager trying to save their job or save their bonus, and that's why I'd be a little cautious right now.
Gotcha. And if you can mention any Canadian companies to watch, who are they and why?
Some of our favorites, one of our favorites right now is Saverio Corp. It's a company that is right into the demographic play with the older population. They provide mobility devices, and they just bought the mobility division from Shoppers Drug Mart. Here's a company, it's growing at about 30%. It has a very clean balance sheet. Management owns a bunch of stock, about 40%, and they're just really knocking it out of the park. It's about a $250 million market cap company. It's not that well known, but it does pay a dividend. We like that. And we like the attention, we like the growth, we like the demographics. Another one which has gone well up, and we still think it's very attractive right now is Kinaxis. It's a software sales management company. And what we really like about Kinaxis, they have $100 million in cash, they have no debt, they're solving a problem for companies, they've got a cloud-based solution. But the thing that really is interesting right now is their average contract size is increasing. So that means that customers are becoming more comfortable with their product, they're getting bigger customers, higher margins, and here's a company that's growing very rapidly, and it's sort of a new Canadian tech leader to replace some of the other ones that haven't done so well.
Well, very good with the tech. Do you have any other topics that we can hear about?
Sure. One that's sort of perhaps a little bit boring in terms of what their business does, but certainly not boring from the stock, is Premium Brands. So to put it simply, Premium Brands, they make sandwiches for institutions. So your university, your hospital, when you go into one of those catering machines and you pull out one of those sandwiches, they've probably made them. They've got a great market share, they've done great acquisitions, and here's a company that at 5i, we wanted to follow it about 3 years ago, and the stock was much lower, and we finally said, you know what, this company is just delivering on all fronts. They're making good acquisitions, keeping their balance sheet proper, earnings growth is phenomenal, and it's still not overly expensive. It's still in the 20 times earnings range, which some people think is expensive, but for a great company, we think it's cheap.
Oh, interesting, because I know that University of Toronto is recently changed over to using its own kitchen. Is that possibly a challenge for this kind of company?
It's always a challenge, but certainly in the institutional world, outsourcing is becoming a bigger and better thing. There's always going to be companies and divisions that go the other way, but certainly that hasn't slowed them down so far.
Okay, great. And how can our viewers learn more about you and also about 5i Research?
So we have a website, 5iresearch.ca. We have really 4 services now. We have research reports. We're independent. We don't have any affiliation with anyone. We don't manage money. We're not allowed to own Canadian stocks. We answer questions like those popular TV shows. We answer questions. We've answered 46,000 questions to investors so far. We have model portfolios that people can follow, and we just started a portfolio review service.
And interestingly, you just mentioned about 46,000 questions answered. What are some common things that you advise people on?
Sure. Our biggest probably theme for a question is not to worry about the short-term gyrations. Stocks go up, stocks go down, and we get a lot of clients, they worry about, oh, my stock's down 2 or 3%. It means nothing. If there's no news, it could be someone needs to raise money to buy a house. It could be a management change at a fund. It could be anything at all. If you look at it from a portfolio approach, you're going to be much better off. And just on that tangent, the other thing we've really stressed is don't look at the TSX. The TSX is not a good index to look at in terms of diversification. There's 10 sectors, but 3 sectors account for 55 to 60% of the market, and you'll get all in a tizzy if you're behind the market, but just ignore it. Own all 10 sectors, have some reasonable diversification. Tilt, if you like industrials, tilt industrials, but don't go 60% financials and resources, which is what the market is.
Thank you, Peter, for being on SmallCapPower.
It's been fun.
To learn more about 5i Research and also to watch other expert interviews, go to the website. I'm Rachel Lee for SmallCapPower.